Who won? Who lost? Is there such a thing as winners and losers?
So thinking about the long-term return that emerges, 10, 15, 20 years, is what's most important.
The market really focused on what opportunities can be created through artificial intelligence.
Hello and welcome to Super Insider, a podcast on all things investing, superannuation, the economy, retirement. Today we are talking about the investment performance drivers for last financial year. We have our investment team here on the couch to talk about the asset classes and to answer your most asked questions about your very precious retirement savings. Now, before we jump into it, I just want to remind you that this is general advice and general information only. Please do not act on anything today without jumping online, doing some reading, playing around with the calculators, even better, giving us a buzz. Talk to one of our financial advisors or talk to your financial advisor and we can help them help you. So let's get into it. Ian, let's set the scene for the year that was. What were the trends? What did the market do and how did this drive performance? What are you most proud of?
What am I most proud of is that the performance delivered off the very broad base that we have. So what are we setting out to do? We're setting out to design a portfolio that's well diversified and hopefully responds to the majority of circumstances. And if I think of what circumstances existed this year, you can boil it down to two. Things digital and AI and things geopolitics. And so if we carve up the year, first half was all about economic resilience and things digital. The AI investment boom continued to drive markets. Markets did solidly, notwithstanding a couple of minor wobbles. We then came into the first quarter and, of course, geopolitics hit the headlines with the Iran war. And we had the only weak 3-month or quarterly period during the course of the year. But that did continue through the balance of the year because the oil shock drove inflation fears, which drove up long-term interest rates. And so we've seen weakness from fixed interest assets. But equities shrugged it off and went, well, this is a little blip and I'm not diminishing the human casualties or anything of that order. But this is a blip and AI is going to push through and continue to deliver fantastic returns. And so the last quarter of the year was a bumper year for equities. Now, in our portfolios, we've got a whole bunch of assets playing a role, everything from listed equities to unlisted assets. That's our diversification story. And so we rode the tailwind of equities. Unlisted assets provided very solid performance and, importantly for us, some level of inflation protection given that there was a blip in inflation.
What's your advice to members as we are facing into quite the transformation of the world really with AI and how to view long-term investing their money here with ART?
Well, the most important thing to take away, and I know we say it often, but I'll say it to my mother, my brother, my kids any day of the week. This is about setting up your futures. And so thinking about the long-term return that emerges, 10, 15, 20 years, is what's most important. If I look at the last year, we had a pretty good year in terms of what portfolios like ours delivered. We're on the third straight year of near 10% returns. That's pretty good. It may not remain quite as strong. I think we're at a point where sentiment has gotten a little bit carried away in some respects. In other words, people are more optimistic than perhaps the world would indicate they should be. And there's some uncertainties around the fundamentals, meaning are we going to generate the earnings from all this investment in AI? But what do we want to do? We want to make sure we continue to deliver returns, the 10% return from the high growth option over 10 years, cognizant of the fact that the 1-year return will get people's attention, and for the high growth option that was 9.2. A very strong return given the volatility that we saw in markets.
Liz, tell us about the drivers for investment performance this year, the asset classes, who won, who lost, is there such a thing as winners and losers? Tell us.
Yeah, well, I think the big theme that Ian touched on that was a real key driver of markets this financial year was artificial intelligence. And despite the headlines or ongoing headlines around things like tariffs or geopolitical tensions or economic uncertainty, the market really focused on what opportunities can be created through artificial intelligence. So the biggest beneficiaries of that was global shares. If you look at our international shares option over the year on a hedged basis where currencies are completely neutralised, it had an extraordinary return and delivered 23.15% over the year. And then if you include those currency impacts, it delivered a return of 15.7% over the year. And that was really driven by strong returns from those large technology companies on the back of optimism around AI. But as Ian mentioned, it's really important to look at the longer term. And if you look at both of those options over the 10-year horizon, they both delivered around that 12% or a little bit over 12% per annum over 10 years. So it really does highlight the power of long-term investing. Then if you look at Australian shares, it had a solid return. They delivered 6.2% over the year. So it wasn't quite as strong as global markets, and that really reflected the fact that our Australian share markets have more exposure to things like banks, resource companies, and considerably less exposure to those technology companies that are expected to drive the AI boom. But again, there was really solid returns from our listed property index. It delivered 13.43% over the year. So they're continuing to see their recovery post the challenges that property markets experienced during and immediately after that pandemic. But importantly, again, if you look over the longer term, that option's delivered really strong or solid returns around the 6.43% per annum over the last 10 years. Now, if our members were interested in investing in markets outside public markets, they could invest in the unlisted asset class option. And that option does invest in unlisted infrastructure, private equity, private credit, property and cash. And it's delivered a solid return over the year of 5.69% and 7.5% over that longer term horizon. Now, those markets have underperformed public markets over the short term, but we continue to have very strong conviction in the unlisted markets and believe that they provide really strong characteristics and strong diversification to a multi-asset portfolio. So they were the big performers over the year. But if you look at the more defensive end of the spectrum, you've got bond markets, as Ian said, who still delivered positive performance. And over the
So even they were winners.
They delivered positive performance. Over the short term, I think the bond market delivered about 1.8%, and that has delivered really low returns for really the past decade now, and that was due to the longer term trend of low interest rates, where it really started to reverse around 21. But then the cash option delivered a solid return of 3.8%, and that's because interest rates have risen from really historical lows, which is reflected in that longer term return of 2.32% over the 10 years. But I think what's really important to note, and it does really tie back to what Ian highlighted, is that what these returns show is that despite all the different themes that have come in and out of the market over the last 10 years, and despite the ups and downs that Ian touched on, in general, long-term investors have been really rewarded by staying their course and staying invested. And so it really does highlight the value of time in the market rather than timing markets.
And I think, Anne, we should have two viewer notes. One is past performance is no guarantee of future performance. And the second is these returns that Liz has been talking about are after tax. So sometimes people look at the cash option and they go, I can turn up to the bank and get a higher return. Yes, you may be able to, but that's before you pay tax on it, whereas taxes come out of these returns before we publish them or credit them to member accounts.
Ian, I was wondering when you were going to jump in, and I thought you were going to jump in when I just said winners and losers, because that you were going to point out that all of these different asset classes at some point are going to be winning or losing in the cycle, and that's why it's the power of diversification. But as a global investor with incredibly strong cash flows, we have the luxury of investing for the long term in assets that the ordinary the ordinary person doesn't have access to that really help stay the course and deliver that strong performance, which is where I'm going to bring you, Mr. Weaver, into the conversation. Because unlisted assets are something that we are so proud of in terms of their contribution to the performance for our members and delivering the number on the tin. Let's have a yarn about that.
So unlisted assets are an area that we've been able to invest in for a very long time at ART. And we invest because we believe that unlisted assets will get better long-term returns for our members. All right. So not every year, but over the medium to long term, we expect an illiquidity premium against what the listed markets will do, whether that's the share market or the bonds or the bond market. So when we think about unlisted assets, we're talking about private equity and private credit, where we're having diversification across both managers, opportunities, different underlying investments there. And then also infrastructure and real estate, both real assets. We're investing in assets both here in Australia and around the world. And it's diversification across those asset classes, but also within the asset classes. Infrastructure, for an example, we invest in Brisbane Airport, Sydney Airport, Heathrow Airport. We're investing in energy assets such as Electronet, AusNet, even Pattern Energy over in the US. Very large, globally significant assets that we believe will continue to generate good long-term investment returns for our members. Now, why can we do this? You mentioned before, we're one of the largest funds in the country, actually one of the largest funds in the world. So we've got scale advantage where we can access with some of the best investment managers in the world some of these sorts of assets. We can source them well, buy them well, manage well over the long term. On occasion, we might sell them. Otherwise, we'll just continue to generate good long-term returns for our members over time.
Look, I'm going to call out because you won't. And like you've been at ART, 19 years? Yeah. But certainly I think deep experience and capability within this asset class that is unlisted, I think is incredibly compelling. And we're so proud of these assets that we invest on your behalf. There's some really interesting stories, of which there's plenty of back episodes of Super Insider. Michael, is there just one or two stories you just want to pull out of the portfolio just to bring to life for our members?
We're fortunate to have long-term experience in the asset class and have good teams of people that have been able to work with our partners to find these sorts of assets and invest well and create great long-term returns for our members. But we only invest if we think that we will get better long-term returns than what we could get from the listed market. Otherwise, we wouldn't spend the time and effort doing that. Over the last year, we've invested over $3 billion in Australian real estate investments. The largest one of those is Westfield Sydney that we invested in relatively recently alongside Centre Group using our partner QIC. That's an asset that's well known to many people in Sydney. It's the largest shopping centre in the middle of Sydney, and that's the sort of asset that we can own for a very long time and can generate good returns for our members. But many other assets that you mentioned, such as the holiday parks with G'day Parks, they're assets we've invested in for a long time, continue to be able to grow with us, building larger holiday parks or buying more, and being able to invest long term. Recently, we've also invested more with Mirvac into both industrial logistics assets and also the build to rent. Those sort of assets, again, are ones where we can get good long-term returns for our members, but also helping generate economic growth in the communities that we're investing in, which we think is a bit of a win-win for our members as well.
Yes, there's no point retiring if the community you're retiring into, it's not prosperous and safe and future ready. And so that's all of these assets are very much aligned with that. Ian, you spoke about maybe people should temper their optimism around investment returns, future returns, and you did do lovely GA warning. Past performance is no indicator of future performance. Could you give us a sense of where are we heading? And then we might jump to some member questions.
Yeah, with pleasure. And the one thing we do say, and this is going to sound like another caveat, but it's important to make the point. The one thing that we do say is we don't believe we have a distinct advantage in forecasting. Our job for our members is to ensure that they can retire with confidence. And part of that confidence will come from, as I said at the beginning, a well-diversified portfolio with exposure to most of the economic activity that we can access for investment. To your question about is sentiment slightly ahead of itself? I think the fair answer to you and the honest answer would be we don't rightly know. Artificial intelligence and all the associated technologies are very transformative. We hear stories about the advances in productivity in coding and some other tasks as a byproduct of artificial intelligence. That's real. But there are vast sums of money being deployed, over 500 billion each year over the past few years into artificial. That has to generate a substantial return to make it worth it to a shareholder or a bondholder who's put up that money for the investment. And that's where I think it's gotten a little bit stretched. Now, that's not to say artificial intelligence isn't real and we're facing into a stock market correction. I just think the actual proof points on those companies being able to generate that level of earnings are still very early on in the season, and you shouldn't get too far over your skis. That's my point.
Don't count the chickens.
Yep.
As the saying goes. Okay, well, now we will get to the most asked member questions as it relates to investing. Ian, this first one is for you. What's our top performing asset?
Now, that's a fascinating question because I could point to a very small company called SanDisk. And if you're involved in the story around AI, SanDisk is the memory chip in your camera. There has been fantastic hype around memory chips. That means SanDisk has gone up over 4,000% in the past year. But the reality is our exposure to SanDisk is next to nothing. It's a small company. So what has actually made the most difference to our portfolio? It's BHP, the big Australian. Why? Well, BHP had a stellar year, a return of over 60%. Why? Because in addition to the iron ore we know about, it mines a lot of copper. Copper is absolutely central to electrification, AI, and all those things. And because we own a big chunk of Australian shares and BHP is a big chunk of the Australian share market, we actually own just over 3% in the high growth option in BHP. 3% earning 60% gives us the largest contributor to the portfolio over the year. We had other great assets. There were some data centers in the infrastructure portfolio that did really well, but if you want the specific answer, it's BHP.
What might be interesting to say just on top of that is that example is actually a really interesting example of how to play or take advantage of the AI theme without having to pick the specific winner, which we know from historical technological transformations is very, very hard to do. So it goes back to the diversification and having exposure to a broad spectrum of opportunities that take advantage of these long-term themes, but taking into consideration the risks, which Ian spoke about around the optimism of forward returns and the challenges of really knowing who are going to be the winners going forward.
Good. All right, Liz, there are 3 questions. The first is, how should I pick my investment strategy? When should I switch my investment mix? Crystallization. What does this actually mean? Over to you.
Great. Okay. So how should you choose your strategy? Well, really, there's no one size fits all, but a good place to start would be to understand when you're likely to need to draw on your superannuation, and importantly, how comfortable you are with the ups and downs, which is your risk tolerance. If you have a long term to retirement before you're needing to draw down on your money, then you can probably tolerate some of the market fluctuations. We've spoken about the ups and downs quite a bit already. Then you can probably tolerate those ups and downs. However, if you're about to retire relatively soon and need to draw down on your money, then you probably haven't got the same appetite for that kind of market fluctuations, which would suggest that you might need a lower risk option. One really important thing though is how much appetite you've got to really stomach those ups and downs, because the best strategy is often the one that you can stick through the good and bad times. We did speak about earlier that the best strategy is the time in the market rather than the market timing. And if you end up switching after a period of underperformance, you lock in that underperformance if you switch to a lower risk strategy.
And that's the word crystallization.
And that is the word crystallization. So what that means is if you lock in what would really be an unrealized loss, and if you stay in the market, you can make that back up when the market recovers. But if you lock in that loss, that's called crystallizing that loss, and you've now lost the opportunity to make up those gains going forward. And if you lock in those losses, you really have to make a second decision as to when you get back in the market, which is really, really difficult from a market timing perspective. So when should you review your strategy? Regularly. It is important, but really it's only if your risk tolerance changes, your goals change, or your time horizon changes. So I think you have opened. I think it's probably a good idea if you're challenged with when some of those elements, really reach out to a financial advisor or use some of the tools on the website.
For those of us around during COVID, we saw so many members lock in losses. With all of the volatility that we now just experienced, we are seeing more and more members have the patience to stay the course. They're educating themselves by listening to podcasts, and they are staying the course, and less of our members are locking in or crystallising the losses.
And it is really important to have a clear strategy, because if you're informed, you know what to expect. And so if you do see those big drawdowns, which are a normal part of investing in equity or global share markets, where there is the higher potential for higher returns, but there is the expectation of a lot more volatility along the way. So if you go in with an informed strategy and know what the likely path can take, you'll be more confident to stay that course rather than reacting and responding in the short term, which could cause more harm than good.
Michael, how do world events impact investment performance?
The simple answer is quite a lot. The more detailed answer is, if you break it down into the types of world events that occur, I'd probably put them in three main categories. One is technological change. We've spoken quite a lot about technological change of AI and the implications of that, and what does that mean. That will change people's expectations about future returns, as you would expect. And so people will pay more or less for assets depending on what they think those future returns will be impacted by. Then you get political change. In there I will include wars and conflicts, and we've seen some of that recently, which is really tragic. However, that also changes people's perceptions of what future returns will be. The uncertainty of those implications of those events means people will look at it, increase the risk that they see in relation to future returns, and generally pay less. But sometimes people do look through that, as Ian mentioned in some earlier comments. And so that's something that we need to think about whenever we're looking at new investments or assessing what we currently own as well. The third area I would put in regulatory change. And sometimes that's linked to the political change. Regulatory change does impact on how people think about investing, whether it's here in Australia, offshore markets, whether people would want to invest more or less in different countries or in different sectors of a country. That could be tax changes, it could be climate change related, and the sort of net zero 50 ambitions that many countries have, and what we'll need to be investing for the future. And if you put a couple of those together, one of the interesting implications of recent world events is the specific impacts on oil and gas, and also the energy security issues that people are thinking about. How much energy security does each country really have? The global supply chains that are all interlinked, and do you actually control your own destiny, or who are you relying on? And so there's a lot of focus now on increasing energy security across different countries, and that does relate to energy and renewables, and we've been investing more into that area as we see more and more investment required in that area, but also because many countries want to have more energy security over time. So quite interesting seeing the different interplays of any world events across those three areas.
So we've spoken to energy, which is a nice segue to the last of the most asked questions by our members, which I'll throw to you, Ian. What do we invest in? How do we invest sustainably?
What's the principal anchor for us? At the end of the day, good returns will follow from suitable management of the risks and opportunities associated with a number of sustainability factors, things like climate change, energy efficiency. And so what we're aiming to do when we think of our portfolios is ensure that we are looking 2, the risks and opportunities associated with those sustainability factors. Factor that into our analysis and our assessment of the managers we use to undertake the investment for us, and ensure that we have the appropriate consideration and risk and opportunity lens on those sustainability factors. We have a very small number of exclusions, but our fundamental belief is those are irreconcilable with the risk presented by not managing them, so we tend to exclude them from the portfolio. Everything else we should focus on managing the appropriate factors so that we improve the overall system and improve economic performance as a consequence.
It's been a big chat. So what do you need to do? Call to action. There's no point listening to this if you're doing nothing with it. You're a motivated person because you have spent half an hour or so of your time listening. So you're going to make sure you've downloaded the app because you have your banking app on your phone. So you're going to have your super fund app too. You're going to know what you're invested in. You're going to think about what your number is. You're going to play around on calculators. You can pick up the phone. This is a really important time, new financial year resolution. Pay attention to your super. It's your money. It's going to make sure you have the best possible retirement. Thank you so much for joining us at Super Insider, and we'll see you again soon.